Hey everyone, Siam here, back for another macro metrics video. So this is going to be a bit of a weird one because I have bugger all internet at home at the moment. I have a nightmare. The house is in a bit of a dip, surrounded by really tall trees, so we don't get 4G signal. We don't have a normal ADSL line. Well, we do have an ADSL line, but it does 3 meg up download, 1 meg upload. And it's intermittent, which doesn't help. Satellite internet didn't work. We tried that, and we've tried a bonded internet line, or a couple of lines. That didn't work. So I guess we're gonna have to bite the bullet and get a leased line. But so what I'm doing is I've got my little dongle. I'm sat in the car outside the Burger King, and probably can't see it, Burger King and Greg's car park, because this is pretty much the only place I get 4G in this area. So I've got no real agenda for this, or no sort of schedule for this video. What I'm going to do is go through the comments on some of the previous videos, because there's a lot of comments I haven't got back to simply because they need like essay type responses. So let's check out the comments and see what you got. Okay, righty tighty, let's crack on with the comments. So let's just start from the most recent. Okay, Decentrophiles. The video was about what will happen to Bitcoin by 2025, so we're not there yet. Mauricio, what trading platform do I use? I use FXCM because it's an STP broker, so it's a straight through processor broker. So what that means is my broker does not trade against me, and my trades go directly onto the market. Whereas if you use a market maker, then trades, they take the other side of your trade, so that's not good. Okay, macrometrics. So why do they have to increase rates in an inflationary environment? So it's a good question, Beau Champy. So you have to understand that the central banks only have two levers. Or imagine there is a car, okay, and you got two pedals. You have the accelerator and the brake. So that's all the central bank has. So the accelerator, if you put the pedal to the metal, or whatever the term is, that's equivalent to financial stimulus. So in bunny ears, money printing. Obviously there's no actual printing of money these days. So that's, so stimulus, financial stimulus, very much like, the furlough schemes and all the grants that we've had during the lockdown sort of period. That would be, accelerator down, because they're trying to kickstart the economy. They want the economy to start transacting again, so MV, money velocity, can start going up again. And that's the only way to increase MV, by getting money into the actual public, not giving QE type bailouts to the banks, or not bailouts, but giving financial stimulus to the banks, because it never hits the economy. They just absorb it and sort themselves out. So the other pedal or lever that we have is interest rates. So if you're driving your car really, really fast and you see a corner coming down the road, coming up ahead, you need to slow down. So what you do, you put your foot on the brake, and that's the same as interest rates. So typically, if you raise interest rates, it makes technically people borrow less. They save their money a bit more, because interest rates are going up, etc. And so it slows the economy down, so to speak. So when you have an inflationary environment, now by the way, there's two types of inflation. We have monetary inflation, which is the expansion of the currency supply, or we have price inflation, where your milk and eggs and Netflix and all the things that you buy every day. That's when prices go up. So let's say we have both, because they typically go hand in hand. So when you have monetary and price inflation and it starts to run away, then the Fed, they've only got two levers, so they can only do one thing. They can raise interest rates to try and slow down the economy, or slow down inflation. So that's why they have to do it, and that's what they've done for thousands of years. I would say probably more accurately about 900 years, but yeah. Right, Macro, another one, Mr. TZ Salt. You said QE. In fact, I think I've already replied to this. Yeah, already replied. Sarah Lou, no, you don't need to take your money out of the bank, not yet. However, it is advisable to start getting ready to get into crypto. John Garvey, yeah, I agree. Yeah, the first sentence there, it depends how the money is delivered to the public. And QE, it doesn't... So you have to understand that QE, so quantitative easing and other forms of financial stimulus, are there to try and coax the banks to doing things. So you have to understand that the central banks cannot control the banks. They cannot tell the banks what to do. So what they have to do is do things in order to try and coax the banks into doing something. So what they try and do is make things easy for the banks to give them open credit lines, which is pretty much what QE is these days. It's simply an open credit line with the bank's name on. And they're hoping that if they make the lives easier for the banks, that the banks will then make things easier for public to borrow. But obviously the banks don't do that because we, the general muppets, as in the retail market, us, the public, we are muppets in their eyes, and we are high risk. So when Rishi did the Corona business interruption loan, what happened? It was like, yeah, we're going to make the banks lend, and then over the next couple of months, the banks didn't do jack diddly shit. And so then Rishi had to send them a stern letter saying you must give out cheap loans to everyone, and they still drag their heels, which is why they had to bring in the bounce back loans, and that even then some people still had problems. So yeah, it's how it's delivered. What is the time? How long have we done this? 5 minutes. We can go on for a little bit more. So Mayoresh Dagamwa, hopefully I've said that the right way, has said, but we can always create a system wherein government can print money without taking debt from anyone, i.e. Federal Reserve prints money and hands it over to government free of cost without debt, just free as a gift. Why not this approach and cancel all taxes, not just income tax? Yeah, so at the moment, you're correct. So whenever money is created, I hate using the word money because there's no real money these days. Real money is gold and silver. That is the only form of money on the planet. Everything else is currency. So, but yeah, at the moment, whenever they create currency, it's done via debt. But they don't have to. You're correct. They don't have to do that. But that would mean cutting out the Federal Reserve or the central banks, which in many countries are private entities with private shareholders, just like the Federal Reserve, which pay their shareholders 6% dividends per year. This is fact, by the way. This is not like conspiracy tin hat stuff. So, and I think that is where we are slowly going. Well, in fact, very quickly going now, where eventually they will digitize the currency supply, as in they will turn it into a form of a crypto type, they'll call it digital dollar, digital sterling, etc., where they can simply create that and it goes and it's straight in the government's control. And what I see happening is that the government's taking a slightly more control of their central banks these days. So then it will be free of cost, but they're not going to just cancel taxes. They'll just do that. They'll be able to manipulate the M2 without getting into more debt, but then they'll still keep the taxes going. Remember, that tax revenue is most countries' main revenue stream. So, okay, don't you think they are triggering the reset as they are already positioned to profit? Maybe they want to reset the economy. Yep, I would also agree. If I take a mortgage and interest rates go minus, what happens to my mortgage payments? I have no idea, mate. So Stephen said, if you're lucky enough to have your lender give you a negative interest rate, then the outstanding amount will go down every month, even if you didn't make any repayments. You'll still need to make repayments though. Well, that's a long one. So I'm not too sure, mate. Sorry. Right. Let's start tailing off here. So yeah, Lee LFC. Look at your plan for the 3 big plays and the timing of buying Ether from before that. Just interested to know how strongly you believe in the Bitcoin, then alt's price. Blah, blah, blah. Okay. Yeah, I mean, everyone has an opinion, obviously. Except I always back my opinion up with lots of money. Lots of my own money, mind you. Whereas most people, they don't back up their opinions with money, and if they do, it's normally other people's money. So I literally put my, I put my balls in my mouth. That's not the saying. I put my money in my mouth, or whatever. balls on the line, whatever it is. So yeah, personally, I'm eyeing up an entry point into Ether. I think when stocks start to fall over properly, gold and silver and crypto will fall with it, and then I'll aim for a nice entry point, and then into Ether predominantly. I'll have a little basket of other things, like Monero and a few others. Sorry, my mind's gone blank. But what I'm trying to do is wait for the Ether to Bitcoin level to go back to previous highs, and then I'll end up with more Bitcoin in the long run. But I think, yeah, Bitcoin's not going anywhere. It really isn't going anywhere. It's going to be a while until it's knocked off the top spot. So remember, it's only battle tested crypto, and it's been here for 10 years, and it's suffered lots of attacks by governments and prominent people, etc. And it's still here, rocking. Quick one, this is so confusing. I have a wallet already. Why would I make a new one? In case it gets hacked, or you lose the keys for it. You don't want to put all your eggs in one basket. So it's worth having at least a wallet for every type of crypto you have. Obviously, it depends how much money you're storing. So yeah, right. I think that's it. Hope that makes sense. And yeah, thank you for all your lovely comments and videos and likes and whatnot. I really appreciate it. Cheers, guys and gals. Bye.